Hey there. So this is already the 16th chapter about money management and trading tactics. So this chapter basically goes over three elements, which is going to be price forecasting, so where the price is going to go, the trading tactics and timing. So you can an intermediate trend could be to the up, but still, if you buy at the top of current wave, it's not a really good timing, and you'll end up losing actually. So that's why timing is important and other tactics. And also money management, like how much are you willing to lose on a trade, or how much should you spend in one trade, or should you add on if you just made a win on a trade, like what are the rules sort of. So I did this, I wrote everything down in Notepad. I hope it doesn't annoy, but everything is here. So basically let's talk about money management first. So you should never invest more than 50% of your total capital. And this one is taken by, this is mainly about this is just bonds and stocks market. I guess 50% good because then you always have a reserve sort of. Uh, yeah, I feel like, because I'm not sure how much you would have saved up, right? If you're not willing to really, if you're not really needing the money to spend it elsewhere, why wouldn't you just invest? So it's kind of a, I wasn't sure about this one, but I guess if you're trading all day, you should only go with 50% of your money. So the total commitment in any one market should be limited to 10 to 15% of the total equity. What this means is, let's say you have one market. You never want to go 50% of your total capital into one market, because if that fluctuates, it's gonna heavily impact your portfolio. So let's say you have $100,000 account. You should only invest 10 to 15,000 on any trade, on any market. So you can have 10 in Apple, 10 in Meta, 10 in Microsoft. That's fine, right? But not 30 in Apple. That's just too much, and any change will really mess up the portfolio. The total amount in risk in any one of markets should be limited to 5% of the total equity. So here we again have the €100,000 account, dollar account. On any one trade, you should not risk losing more than 5,000. Let's say you go for actually the full 15,000 dollar you invested. Losing 5,000 is actually a 33% loss. So that's quite a significant loss. So I guess that's a fair share. Now the fourth rule is total margin in any market group should be limited to 20 to 25% of total equity. Yeah, so you're not gonna invest in all the tech companies if tech companies start to go bad for some reason, and you still have your money diversified into different companies, it still can go quite the wrong way, because they're both, or like they're all dealing within the same market sort of in the environment. So it's always good to, for example, buy how do you call it, silver and gold materials, precious materials, currencies from other countries. But still, if you, like, let's say the currency of America is always the inverse of what's happening in other countries. I believe you mentioned something like that. I didn't look it up, but that's something you mentioned. So diversification versus concentration. This was basically about the management. Don't put all your money into one single asset, and diversify it, and also watch out for if you're not really putting all your money within the same market. So not all in tech or not all in agriculture, right? Because if one thing goes bad, you will still lose a lot of money, even though you've diversified. Now let's go over to the reward and risk ratio. So basically what this is, how much are you willing to lose in a single trade? So let's say you're entering a trade with €100. First of all, you only want to losing up to 5%, according to this rule. So €5. But still, let's say you make a small trade off that €100. So you invest €50. A common yardstick to really reward your risk, what is being used, is a 3-to-1. So let's say you enter with €10. You want to have a stop loss, or stop loss at 1/4, and the 3/4 you want to have it above the entry. So this way, if you make a win 1 in 3 trades, you're still equaling out the other 2 losses. right? I think it's fine. I didn't really study it well. I just wrote it down. Yeah. So the also trending markets and units. So basically, what you want to do is invest in long pools. So just invest in basically bonds are pretty good. So don't look at it again. And then you have other money which you want to have for the short-term trading. Yeah, that's it. Also, never increase commitments after winning a streak. You can add small commitments after you just won a trade, but never add like more and bigger commissions to a streak, right? Because you've already got the money. Chances of going higher aren't significantly higher than it was before. So, tactics on a breakout. Should you anticipate or react? What should you do? It really depends on the situation. If you have a breakout to the upside, it could bounce back down again, and like sort of you wait for the breakout. You wait for the breakout to touch the trend line again, really, or like any line really. Just wait for the breakout and the pullback, and then you can enter, or you can already anticipate it's gonna go shoot to the upside, or you can buy like when the the bullish thing is happening, right? But it's really about how conservative do you want to be, because I'd say the most conservative that you can be is really seeing the breakout, waiting, seeing it pull back 40 to 60%, and then going in for a trade. And then you should also apply, of course, the other rules I mentioned before. But yeah, just really look at support and resistance lines, percentage retracements, like 40 to 60% is good. Price gaps, and of course other technical concepts such as oscillators and moving averages. I'll get on these in a second, but I'll first go over all the other trading guidelines. So I think most of them speak for themselves. There was one I wasn't sure about, which was, let me just read through it. I'm not seeing really any. I guess most of them speak for itself. But I'll just go over the different types of trading orders. So here we are again with the types of trading orders. Yeah, you probably already know these two, and I'm pretty sure the third and fourth are kind of familiar. Only the market if touch was new to me at least, but I'll just go over them right now. So a market order is basically whatever the price is right now, I want to go for a buy. And yeah, that's pretty much it. There isn't really something happening here. You could go for a short as well. Doesn't really matter. But just whatever the price is right now, you wanna go for that price. Yeah. So let's say you have a limit order. This one is most of the time used whenever you're expecting the price to go somewhere, or a bit of a pullback, or whatever it reaches. So let's say I'm expecting it to go long, but today's Monday and the market opens in 4 hours. I believe it's going to go down, right? So what I'll do is actually put my buy order a bit lower, for example. So now when the market opens, it will initiate a buy order at this price. So, and let's say the market actually opens right here, so even lower, it would immediately initiate this trend as well. Because, well, you've actually taken up 4% more even than what you were expecting. So that's a good trade. But if a market ends dead low, it could also go this way, right? So that's the risk about a limit order. But it's not really a risk because, well, whatever. You could also lose the market because it could never come back. But that's really what could happen. So let's go to a stop order. So basically, let's say you are in a trend or in a trade right now. I'll just make it gray to really stand out. Oh, you can't even see. Well, you're in a trade right now, and there's not a take profit, but there is a stop loss. So let's say whenever the prices reaches this, you will be selling. So what does it mean? So actually, I'll take it back here. So let's say you enter the trend right here. I'm not sure if this is, yeah. So, and the next day, the market opened extremely bad, right? So within one day, it sunk 24%. That's kind of that's not really good, right? So what ends up happening is you're in a trade right now, and market starts here. Now you will actually immediately sell your assets. So this is the stop orders, really like get out of the market as fast as possible without caring about the price. And what you can see is actually the price retraced back. So that's kind of a bummer, right? Because you just sold at a really bad price because you just wanted to get out of the market. So what is even a better option is the stop limit order, which is almost the same, but what happens is this. So let's say we still have the stop order here and we have the limit order right here. So what happens now is the price will get sold, like let's say it manually went here, it will get sold. You sell your assets, nothing really happens. But now the market actually ended up here and it started here. Now nothing will happen really because it will only sell those stocks whenever it reaches this orange line. So you can also make a text out of it. So this is stop limit, like a limit price, and this is a stop order. Stop order. Oh, that's really how you can use it. You can use it in the short as well. But yeah, I'm just showing an example of when you're going into a long. So that's really what this is. And now we have the last one is a market if touched. And to be fair, this one is kind of like a limit order, but at the same time it's just a bit different. So let's say I want to buy the Meta stock at 143.9. So I want to buy it right here, this green line. Now I won't just be buying it when it reaches this price. No. I'll be waiting for example, the market to touch this line, this gray line. So whenever the market touches now, I won't be going into a long. I will only be going into a long whenever it reached this gray line and actually went down again. And it went down again. Now I'll be buying. And this is good, for example, when you're trading in the trend. So let's say this situation is actually going on. And what happened was the trend was going on and you were expecting sort of a downfall as well, like this. I'll just make it a bit thicker. Like this, it could be a good trade to use a market if touched limit or market if touched. And those